Many investors and traders who like gold and precious metals generally seem disappointed that there has not been much progress made this year. Perhaps not surprising, as money has clearly been going into equity markets with Wall Street and now the DAX and the CAC 40 having risen to new record highs. But what about inflation? We're told that gold is a hedge against rising prices. Now, if markets do indeed price in future expectations, and there may be an argument that gold should indeed be higher because of the rise and future pricing of inflationary pressures. The other questions is whether cryptos are stealing some of that safe haven play. Charlie Morris joins us now from ByteTree Asset Management, a research-driven investment advisor. And Charlie is a founder of the company and is chief investment officer. And while has a long track record in traditional asset classes, Charlie is best known for his expertise in alternative assets, notably gold and, more recently, Bitcoin. Charlie, welcome. It's good to catch up with you again.
Great to be here. It's been too long.
Indeed, it has. Look, before we get into gold versus cryptos, let's get your thoughts and your standpoint of what's going on in a broad market sweep. What are your thoughts?
I think that this recovery is twofold. It's, partly the pent-up demand from a lockdown, and it's also, a lot of stimulus. I think if you go back to pre-COVID, to what was happening in the markets in sort of early 2020, things weren't happening. They weren't happy. The bond yield was collapsing, inflation expectations were drifting lower, and so forth. And so we were just sort of there was a sort of realization that nominal and real GDP growth was going to be pretty low long into the future. And so in some ways the whole COVID thing was pretty convenient for the monetary people, because it gave an excuse to have a massive stimulus package. Now, I think that much of that transitory inflation, supply shock stuff will ease off, and then we're left with a situation we were in before. How's it different this time? Well, I would think that the green agenda is going to be a huge source of demand for the global economy, which obviously is a good thing from a market buoyancy perspective. But against that, you've got China. And China, I think, of the last 20 years or 30 years, indeed, has been probably the most significant driver of growth around the world. We've had the first cockroach, as they say, which is the Evergrande debt problem, and I think that spreads. There's obviously a lot of credit in China, and the authorities there have a lot of levers to kick the can down the road. But ultimately, I think that we have to say that China is no longer this big engine. There could be some market shocks around it, but I'm not forecasting that today and how, why, and when. But it's a slow China is no friend of the world, and in a world where growth is naturally pretty slow anyway. So valuations are really high in lots and lots of areas of the market. There's dominance from a few companies, and all these sorts of things tell us it smells a bit like 1972 in markets. And if the inflation shock continues, not through the supply constraints, but through the continued stimulus through the green agenda, which seems pretty likely to me, then markets aren't going to like it. Markets don't like inflation.
Is it time then to de-risk?
I think that when it comes to de-risking, it's one of those things that you kind of always want to have that at the back of your mind. You want to maintain your portfolio balance. I think it's certainly time to be less enthusiastic about all these sorts of things that are going on around us, which are clearly highly speculative. So you've got sort of bubbles everywhere. It's not just in tech, but a company like McDonald's, for example, because of the discount rate so low, I think it trades on 9 times sales. Again, this is a company that's been trading for years and years and years at sort of 2, 3, 4 times sales around the cycle. So every time you go and buy a burger for $5, you're putting $45 onto the market cap. I mean, it's something that is a bit crazy. And then there's other examples of things like Tesla. They just don't make any sense, and ultimately they can not make sense for a long time, but they will always make sense in the end.
Just going back to the comment you made about inflation and this push down in prices initially, and then we've got all this monetary stimulus going in. How do inflationary pressures that we've got at the moment play into current thinking? We are, at the time of recording, just waiting for the Bank of England to announce on its latest interest rate outlook. We've seen the Fed last night beginning to taper. We know that there is this upward pressure on interest rates from central banks who, let's face it, have been at these record low levels. So there has to be some correction at some point. But what about the inflationary pressures? Do you see them you mentioned the word transitory. Do you see them becoming more entrenched, or do you think the transitory nature of these rise in prices that we've seen so far are all that they are, and they won't be with us much longer?
I think it's a bit of both. The thing about the transitory thing, areas will cool off. So we've seen freight container rates, and we've seen certain parts of the gas market. These things will come and go. But in an inflationary environment, I'm reminded that in the 70s, you squash one and another one pops up elsewhere, and it becomes a bit of a habit. But really, inflation comes from private banks or commercial banks, and they're lending into the real economy. So far, all this money printing and stimulus really has not left the financial system. So we've seen high asset prices on the back of it. We haven't really seen consumer price inflation, which, by the way, is the average cost of living for the average person. And I think people get mistaken and carried away with other things it might mean. It's really nothing to do with asset prices. It's really how much does it cost you to live if you're on a modest wage. And that is the force, I think, that will become structural, because the banks have every incentive to lend, because they've got high capital ratios now. The worst is behind them in terms of all the post 2008 anguish, and a lot of the lending is going to be backstopped by the government, particularly when it comes to these green programs, which, by the way, are vast.
But there is a lot of debt around. There's no doubt about that. And that is something that presumably at some point we're going to have to deal with, unless inflation erodes that debt down to a more manageable level. How do we deal with the amount of debt that we've got, not just personally, but on the corporate balance sheets? And as we know, the trillions of dollars that is being has already been pumped into the market that's on the balance sheet of central banks as well.
Yeah, I think pre-2008, the problem was private sector debt. Now it's very much public sector debt. And as you say, how do you get it down? Well, financial repression. You make sure that your nominal GDP growth exceeds your debt growth, basically. And so if you do manage to do that, then your debt GDP will start falling again. I mean, that's what happened in the 1970s. So, I think that's going to be a matter of policy. The secret here is how they can control the bond yield. So people would assume that if inflation goes to stays at 5%, the bond yield will go to 5%. Well, we know that would cripple the system. This time, with so much debt around, they're going to try and keep that down. And the mechanism for doing that probably won't be QE in the long run. It will probably be just encouraging forcing institutions who pension funds and so forth to continue to own lots and lots of gilts, even though the managers in charge of those programs probably wouldn't want to own them.
So let's now steer the conversation around to that age-old story about where do you go with your money if you want to be protected a little bit. And of course, as I said at the top, gold bugs who have wanted this gold price to move, I would say gold is the obvious choice. At ByteTree Asset Management, you've moved into an area of the market that is new to a lot of people. And indeed, you admitted before we went live that it is only a new market, and you've moved into this. You have a traditional investing background, but you see an opportunity in cryptos. To what degree can cryptos and gold work together in this sort of space? Or are we talking about two different markets with two different dynamics, and you wouldn't be interested in both in the current situation?
Absolutely. So a lot of people are sort of asking the question whether they should own gold or Bitcoin, thinking that Bitcoin is the new digital challenger. And, there's some merit to that conversation. But actually, I think they're fundamentally different. And I think it's gold and Bitcoin, not gold or Bitcoin, that is the answer for an inflationary hedge. And the reason for that is very simple. Is because they both like inflation. There's no doubt about it that when inflation rises, gold's happy, and when inflation rises, Bitcoin's happy. But the difference is whether we're in a risk-off or a risk-on environment. And I think the best illustration really comes from 2020. If you recall, after the COVID crash in March 2020, the gold price went down a bit in dollar terms. Obviously, it didn't in sterling or euros or what have you, because there was a dollar spike. But then, as soon as that was eased, gold absolutely roofed it. I mean, gold had a spectacular Q2, only to peak out in early August. And during that period, the gilt yields, the US Treasury yields, remained extremely low. We were still talking about negative bond yields and that sort of thing in Europe. And it wasn't until around October when the bond yield started to move aggressively. The bond yield moved up higher, so really reflecting a macro risk-on environment which favored commodities and hard assets and so forth. Did gold hand the baton to Bitcoin? And at that point, money started to come out of gold. Gold had attracted $50 billion of inflow into the ETFs in the previous year. Bitcoin far less than that. But then once the bond yield started rising and we started to go on a risk-on environment, and it was clear that the economy was actually recovering, then Bitcoin had all the glory and went from 10,000 up to 40,000 in January, and then later on to 64,000. And all of that happened whilst the bond yield was rising. Incidentally, when we had a bit of an accident in the bond market in April, May time, and the bond yield started to come down again, gold had its first counter rally, despite having fallen quite a long way over the previous few months, and Bitcoin went down. So you've got these assets that work against each other, which I think is the perfect thing in portfolio management. You're looking for things that go together, which the long-term outlook for both asset classes is upward, and yet they go up and down at different times. Therefore, that's efficient portfolio diversification. You don't have to market time; you can just own these things, and happy days for the inflation hedge. So I think gold and Bitcoin is a really, really neat way of getting there. And my final point would be, gold is the number one commodity. It's the most liquid, it's the most distributed, it's the one with the most market depth and so forth. And the same is true for Bitcoin in crypto. So you could ask the question of why don't you just own silver and oil and all the other stuff? And similarly, why don't you just own a whole pile of junior crypto? Well, the bottom line is liquidity. If you want the greater certainty, then you stick with the best one, the best asset in each asset class.
How do you see that market then developing? Clearly, it's a very young market. We don't know the direction in which it's going to travel. We certainly don't know yet how it's going to be regulated. For my part, I can't understand how central banks are going to want to see Bitcoin and other cryptos develop the way that some real keen players in the market seem to think it is going to develop, and how they want it to develop, mainly because it means that central banks then no longer have control over their currency, which of course is really key to central bank operation, is that they have this control. How do you see the crypto market developing in this sort of context?
Well, I think the first point there is that Bitcoin is not a currency, and currencies are not currencies. They're crypto. So I much prefer that word crypto. It's a new asset class. It's a digital asset.
Right.
I think that's quite important to understand, really. The central banks work happily with gold. Most of them own gold, and the emerging market central banks are really enthusiastic for it. So they're not shy of alternative assets that have certain criteria. Would they buy Bitcoin? Not in a hurry, I wouldn't think. They're still learning. Maybe in 20 years' time, if it's still with us in the way that we expect it to develop and grow, then maybe they'll start to get involved later on. But I can't see many of them, apart from El Salvador and places like that, getting involved in any big way. But there's a couple of sides to crypto. The narrative around Bitcoin is very much digital gold, store of value, monetary asset in the future. That's where people see it going. And that is, and some purists will probably disagree with me here, but in simple terms, Bitcoin doesn't actually have much application other than being big and valuable and liquid and so forth. Whereas other cryptos have got lots and lots of different applications, whether they drive computer games or the metaverse, or communications between computers. And so the tech story is much more, is found more readily in the junior, fast-growing crypto space, whereas the monetary story is really found at the top. And some of these things, these platforms like Ethereum, enable all sorts of things to happen. And the most tangible, relevant one that springs to mind is the stable coin. There are now basically $140 billion worth of US dollars sitting on the blockchain. And these are winging around all over the world every day. And it's digital bearer cash. It's a very tangible and real use case for crypto. And in order to make a transaction in a stable coin, then you would need to consume some ether, some ETH, and so that means you have to go and buy Ethereum in order to play. And so that's why there's demand for some of these blockchains, because you're effectively buying postage stamps. And I can see how the City of London and other financial centres will readily embrace digital bearer cash at some point in the future. And there's obviously the conversation whether central banks will be launching these. I hope they don't in the developed world because of privacy concerns and other. It's a private sector job. And but nonetheless, we are going to see a huge amount of digital money, fiat money, charging around the world in the future on blockchains. And it takes settlement times, for example, down from T+3, T+2 to T+now. So it's it's a straightforward tech game. So there are many different ways of looking at crypto. Whether you're looking at the monetary Bitcoin, or whether you're looking at the tech, or whether you're looking at the utility of the space and how it can improve the payment rails of the financial system. There's a lot going on.
That is absolutely fascinating. And thanks indeed for talking about that, because I think this just explains a little bit more about how you and we should be viewing the space. But for my last question. Let's take the interview back to where we started and talk about de-risking. And do you think, given that we've seen a record high for Bitcoin, is gold, do you think, languishing at levels that it shouldn't be? Do you think it should be higher? Do you think there's the opportunity to see gold higher in the months to come? Is there still appetite on the upside for gold?
I have these fair value models for gold, which are published on our website, ByteTree.com. And, they're saying that gold's slightly undervalued, not massively. It's about 10% cheap. On some other measures, it might be slightly less than that. But basically, gold is where it should be. So the other reason I'm convinced that Bitcoin hasn't stolen gold's lunch is gold is doing exactly what you'd expect it to do, given what's happened to real interest rates. That is, inflation expectations in the short end, 1, 2 year, have gone up with all the stories of supply crunch. But at the back end, 10, 20, 30 year, they really have stayed much calmer. And that's what really drives the gold price, because it's a long duration asset. And also the bond yield has basically been rising over the last year, which goes against gold. So gold likes a falling real interest rate. That is the future real interest rate, the 10-year or 20-year yield, less the break even, the inflation expectation. And that was falling from 2018 all the way through to 2020, and it's flattened off since. Why would we see that continue to fall? Well, because the government tries its hardest and succeeds in holding down the bond yield whilst the inflation is allowed to run higher. So if that government policy, which would hopefully fix the debt GDP situation, it would keep normal GDP up, i.e. keep people in jobs and fix the green revolution. If you put all those things together, then gold would be a perfect inflation hedge in that environment, because real interest rates would continue to fall.
Interesting. Look, Charlie, we've got to leave it there, but thanks indeed for joining us. It's great to be able to catch up with you again. That's Charlie Morris from ByteTree Asset Management, a research-driven investment advisor, giving us his update on where he thinks the markets could be from this point on, if we're looking for some sort of safe haven. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.